Let's start with SPY. So if you look at SPY, these are the basic indicators that I use for my trading, DMI, RSI, Bollinger Bands and Keltner channels. And based on what I'm seeing here, it looks like SPY is about to go into a pullback. Now, if you look at DMI is also showing change of direction. Having said that, I would like to point out that, like all indicators, you have to take a lot of factors into consideration when making a directional assessment, because just because RSI was up and is falling down doesn't mean that we'll have a pullback. Look at the examples in the past. So let's look at this one. In December, RSI was overbought, starts pulling back, but look at the chart, it did nothing. Then again this day, one red candle went back up again. On January 30th, one red candle got bought up. So this is the behavior we have seen in the last 9 months, ever since that AI bubble started. So I don't know what to make out of this, but I'm just pointing out that based on the indicators I use, we could see a pullback, especially that the markets are so overextended. Quick look at QQQ. So QQQ or tech is still not showing any signs of a pullback. SPY is, because look what happened. It was overbought, dipped slightly, and is again showing signs of going back up. So nothing in QQQ, and again QQQ will not pull back unless these trillion-dollar companies, Meta, Microsoft, Google, Apple, Nvidia, all of these start pulling back. This index will not go down. Let's look at DIA. So DIA or Dow Jones has entered into a squeeze, and as you know, a squeeze is basically a period of consolidation with little to no price movement. So we could see DIA just chop around here and basically do nothing. So I want to throw in the TTM squeeze indicator, and as you know, TTM squeeze indicator is simply a visualization of Bollinger Bands and Keltner channels combined together. So when the BBs are trapped inside the KCs, like in this case, you see red dots start appearing. That means markets are going into a sideways movement. And when the red dots start turning into green, that means an explosive move is about to happen. So in this particular example, this squeeze wasn't that prominent, but okay, here is a good example of how these squeezes work. So note that Bollinger Bands are entering Keltner channels on, this is February 2nd, 2023. So Bollinger Bands enter Keltner channels, and then you will see that once that happens, the markets basically go sideways. There's hardly any movement. A red candle here followed by a green candle. So the net price movement is negligible, which is actually could be very frustrating for directional traders. But the good news is that once markets go into this phase, they eventually explode out of that. And if you look at the TTM squeeze, so after this bunch of red dots, we start seeing these green dots start appearing, and the squeeze is firing to the downside. That means an explosive downward movement is beginning to happen, and we did see a massive pullback here. So that's one example of how you can use TTM squeeze. So when the red dots are appearing, expect choppiness and sideways movement, and wait for those green dots to appear, and that will show you which direction markets are about to go. So that's what we are at right now. If you look at today, it's just entering TTM squeeze. So we just have two dots. So we very well could stay here for the next, I don't know, 2 3 weeks and just chop around and eventually break out of that. So we need to see what happens. Now these TTM squeezes don't always pan out, and the reason for that is, so for example, right now it looks like Dow Jones is going sideways, but let's say the core PCE number next week, which everyone is expecting to be tame, comes out hot. If that happens, markets will suddenly drop. So this TTM squeeze, this sideways period will not happen, and markets will immediately go into a pullback. Okay, let's quickly touch on the earnings calendar. There is nothing going on as far as earnings are concerned, which is good news because we don't have to deal with that kind of craziness. So if you look at next week, we do have FDX on 25th June. We have NKE, Nike, on 27th. I think that's pretty much it. And then the following week we have STZ, that's from our watch list. So next 2 weeks, earnings season is pretty much dead. Things will start heating up starting the second week of July, which is when the big banks start reporting. So next 2 weeks, not much going on, which is good in a way because we have enough craziness to deal with. We have PCE coming out next week, so that should keep us plenty busy. Okay, now let's look at the macroeconomic calendar, and there are two things which are very important next week, and which is basically Thursday and Friday. So as you know, jobless claims comes out every week, so and that is always a market mover. So not disregarding that, but in addition to that, we have GDP data coming out. That's a big market mover. But the main event of the week is PCE, core PCE, which is Fed's preferred gauge of inflation. And you must remember that we had CPI and PPI prints that have already come out, and that data point is going to feed into this PCE number. So my expectation is that the PCE number is most likely going to be tamer than expected. And although this is, markets don't usually react to news which is already known, but I won't be surprised if on Friday markets shoot up like 300 points, like Dow Jones shoots up 300 points and Nasdaq ends up with a 2% gain. Now that brings me to the relative rotation graphs. I don't know what to make out of this picture, frankly, because if you look at this, nothing, it looks like money is flowing out of everything. So of course, given that this is slightly delayed data, and Dow Jones made a big move yesterday, I don't know how this is going to shape up, but look at this. I mean, look, based on this, looks like money is just leaving the market. The sector rotation picture that was showing up last week is not true anymore. All I'm seeing is, XLB, XLI, XLF, XLE, XLV, XLY. This is all Dow Jones. So all of these are moving into the lagging quadrant, and the only thing that's in the positive quadrant is the XLU utilities and XLK fueled by Nvidia, which is beginning to go back up. But again, this is lagging data. This is not a forward-looking indicator. This is just showing you how things are looking at the moment. And for example, this will not take into account that Nvidia and the chip stocks are showing some kind of weakness. So this XLK, which is showing its teeth again and threatening to go into the leading quadrant, may not happen. It may drop back into the lagging quadrant. So again, indicators, charts, they were great, but all of them come with false positives all the time. So at this point, this picture is clear as mud to me. This doesn't tell me anything. So I would just ignore RRG charts. I mean, it could. Let's look at it and see how things play out in the future. Because what picture I'm seeing right now is, if money is flowing out of everything, we should get a correction. And if a correction does happen, then we go back and high five these RRG charts. But right now, I don't know what to make out of this. Okay, finally, I want to reserve the last section of these market outlooks for either any interesting questions I may see during the week where members have asked me, or if not, I can just go over a trade that I have taken that week. So in this case, let's look at the trade I took on Meta. I take different kinds of trades in the group. So sometimes I will indulge in a TTM squeeze trade. Many times I'll take trades on broader market conditions. So if some kind of inflation data comes out, let's say inflation data comes out really hot, CPI comes out hot, and markets start tanking, at that point I'll pay more attention to the broader market movement than individual stock setups. And I'll actually, so let's say CPI comes out bad, we know that tech is the most sensitive sector, so I might take some bear put spreads on tech stocks. Even though the individual trade setup may not confirm my trade, but I'll pay more attention to the broader markets. Then I have my typical mean reversion setup, which is, I've given many examples in the book. There are many examples on the website too. And this is one of those setups. So you can see that starting June 12th, the stock has been, let me zoom in so you can get a better picture. So 3-month weekly chart. Starting June 12th, the stock is making lower highs, lower lows constantly, right? I took my trade on this day. So that's one of the indicators I used, just pure price movement. Then look at DI plus. DI plus is constantly going down, which again confirms lack of upward momentum. And finally, RSI is also confirming. RSI is also making lower highs, lower lows, and going down. So that's the reason why I took this trade. And of course, any trade, no matter how good it appears, can go against you. So my goal is to take trades based on my analysis, the rules that I have developed, and the things that are known to me at that moment. What happens after I take the trade is not in my control, and that is why you have rules in place to prevent losers, like the 50% loss rule and the PNR indicator. So let's see how this trade plays out. So far it looks like Meta does want to pull back a little. It all depends on what happens next week. So we could, if this bearish momentum continues, then markets could keep sliding next week all the way until PCE comes out on Friday, and then God knows what's going to happen when PCE comes out. Okay, and one more interesting question I saw this week was this question, where this person is saying that this keeps happening to him all the time. Example, he has a position that is down 40 to 45% going into close. Next day it opens and immediately gaps down 70 to 80%. By the time the next positive day comes around, it's lost 70 to 90% of value. In short, he's struggling to cut losers at 50%. So let me address this question first. So if you look at the flow chart that I have, okay, so this is the flow chart that shows you how to manage your positions. You open a trade here, then it walks you through the different steps. So for example, if the trade is DITM, which means it's making money, you do nothing. If it's not DITM, it's asking you, is the spread ITM, meaning one leg is in the money, other leg is out of the money. If it's yes, then it's asking you if it's only 3 days left to expiration. If yes, close or partial profit. So it walks you through different scenarios. Note this scenario. So if you have 65% loss or greater, close immediately for partial loss. So that's one thing you need to keep in mind, and this is an addition I made last year to this flowchart, because many members, what they were struggling with was they would see a 50% loss on their trade. They would place a 50% loss order and just sit there waiting for it to fill. Now let's say the stock continues to move against you and never comes back. So basically that 50% loss order will never get filled, and you will eventually have a 100% loss. And I made a video earlier about this too, that where I ran a lot of simulations. I will link that video in the description. It's a really interesting video. And basically what I proved in that video is, if you let your trades, if you let your losers go above 65%, this method will stop working for you. And so watch that video. It's really interesting and really proves this point. So if at any point, let's say you saw a 50% loss on your trade, you place the 50% loss closing order, and the stock keeps going against you, the day it hits 65% loss, get out of that trade. Do not hold on to the trade thinking that it might come back. It might come back. For example, that's the next question I'll address. ENPH is one of those trades. The trade actually came back and became a winner. But the point here is that those are exceptions, not the rule. There are very few trades that will come back and become winners. But if you take your trades for let me just give you this exercise. Take last 20 trades that you have taken and go through them one by one. Make note if you had closed them at 50% loss, all the losers, if you take the losers, how many of them actually came back and became winners? So that exercise will answer your question, that should you feel bad about a trade that you cut at 50% loss and it turned around and became a winner? Okay, so hope that answers that question. Put your 50% loss order, but the day your loss goes up to 65%, get out of the trade. So this 70 to 80% scenario, or the trade going to 70 to 90% loss, should not happen. It can happen in maybe in 1 or 2 trades out of 20, but this scenario should not be happening. If it is, please give me an example and I will address that on Discord. The next question, which is kind of related, this person is saying, I'm also finding hard to close losers at 50%. Mostly it's going to 80% loss. If I book at first glance of 50% loss, then winners also get booked for losses. Example, ENPH. Anyway, so I don't think they have explained the question clearly, but I do understand what they're saying. So let me clarify what they're saying. So they're repeating the same thing, that if they see a 50% loss, they put in the 50% loss order and then it goes to 80% loss. So what you're missing here is, you did right, you did put a 50% loss order, but the deal with spreads, vertical spreads in general, this applies to credit spreads or debit spreads. So like, let's say if you had bought a put, just a naked put, and the stock started going against you, which means you bought a put here, the stock starts going up, your put will start losing money so fast that you will not be able to catch it at 50% loss. But with spreads, they are not as sensitive to price movement, especially in the first couple of weeks, or I would say first 10 days of opening the trade. So a trade, you need to give me an example to prove this. So a trade will not jump from 50% loss today to 80% tomorrow or even day after, even if the stock is going against you. That scenario is very hard for me to digest that has happened to you. Not saying that I'm not trusting what you're saying, but give me an example and I will address that. So since the spreads are not sensitive to price movement, the losses will happen very slowly, which gives you plenty of opportunities to get out. So when the day you see a 50% loss, you put in your 50% loss order. The trade starts going against you and that 50% loss order never gets filled, you will have ample opportunities to get out at 65% loss. So if it touches 65% loss, my suggestion is to just get out. Like, don't place an order at 65% and then wait for that to fill. So just close the order at whatever price you are getting for that trade. So that's all I have for this week. Next week is kind of crazy because of the GDP data on Thursday and core PCE on Friday. The way I plan to tackle that is I'll take a handful of trades on Monday and Tuesday, and most likely I will sit back until Friday, waiting for the PCE data to come out. And that way I can either hedge the trades I took on Monday if markets turn against me, or if the markets go in my direction, then I can double down on my directional trades.